So when we're accounting for lease, it's important to know, of course, first, what does the lease contract represent? And so there's two parties in a lease contract. There's the lessee, the one who's using the asset, and in return for using the asset, they pay rents to the lessor. Now, a lease is a very specialized contract in which the lessor tends to keep title to the asset throughout the lease term and even thereafter. They just are allowing the lessee to rent it for a time. You're probably most familiar with this sort of a contract in terms of a car lease, where you lease a car for monthly payments, and in return, the car dealership allows you to use that car. In that contract, you are the lessee because you're using the car. You have the right to use it, even though you don't have legal title over the car. The lessor is the car dealership who's allowing you to have that right. In this example, the title of the car will remain with the lessor. However, in a business transaction, from an accounting standpoint, we are going to record the lease as the lessee as a right, the leased asset as a right of use asset. We're going to emphasize right of use rather than a fixed asset because the asset doesn't truly belong to us. We are just obtaining the economic benefits of renting it and using it to generate revenues over the lease contract. So are all leases the same? No. It's the central question in lease accounting to determine whether or not a lease is in substance a purchase or a rental. And again, note that we're using in substance because even though we may deem the arrangement to have all the characteristics of a purchase, the lessee may not take possession. They may not actually take possession of the leased asset, and therefore we can't record it as a sale under the new revenue recognition standards. So this question used to be far more significant under the old standards. Under the current standards, the difference is far less consequential in terms of the financial effects. Prior to this, if a lease was in substance a rental, then the lessee would not record a right of use asset or any asset. They would not record any lease payable, a large obligation that shows the present value of all the future rental payments that the lessee owes the lessor. So let's look at the new standard and what we call these items when they're classified in substance a rental or in substance a purchase. So for the lessee, if we have something that's in substance a rental, that is, the lessee is not taking on primary ownership, the risks and benefits of ownership, then it's classified as an operating lease. Even when it's a rental, the lessee is going to record a right of use asset, ROU, and also a lease payable. If it is in substance a purchase, nothing actually changes. Again, this is very different than what used to be the case. It used to be the case that if it was a rental, then the lessee wouldn't record these items. They would only record them if it was in substance of purchase. Well, the FASB closed the loophole on this sort of a financing arrangement where the lessee could obtain rights and benefits of ownership in a rental-like transaction and not record any liability or underlying asset, right? It would really benefit the lessee's leverage and their ROA. A lot of financial ratios that the lessee would not have to report deleterious consequences from their leasing arrangements. If it's in substance of purchase, now, again, it's the same as a rental. We have a ROU asset, we have rights and benefits arising from renting the item, and we also have an obligation that is equal to the present value of all the payments we're going to pay the lessor. For a lessor, if they classify a lease as an operating lease, they haven't in substance sold it, so they're just renting it. They do not remove the leased asset from their records. They record deferred revenue as it receives payments from the lessee. So very different than how the lessee records a rental. The lessee actually acts as if they purchased it, whereas the lessor does not act as if they sold it. If it is in substance a purchase for the lessee, then it is a sale for the lessor, and they classify it as a sales type lease. They're going to remove the leased asset from their books because they've sold it, and they're going to record a lease receivable. So when do we consider these as a rental or a purchase? Now, we have 5 criteria that govern it, but in general, if most of the rights and risks of ownership are transferred, then we have a sale to the lessee, a purchase by the lessee. In that case, it's called a finance lease by the lessee and a sales type lease by the lessor. The consequences of that, we've already talked about. The lessee records a right of use asset and a lease payable, both of which are equal to the present value of the lease contract. And so the lease contract is going to stipulate the payments that the lessee is responsible for. They take the present value of all those payments they're responsible for, and that's how they develop the value for their right of use asset and the present value of the lease and the present value of the lease payable. The lessor, as I said, removes the lease asset. They sold it. They get rid of it. So they credit it from their ledger, and then they record a lease receivable for the present value of the lease contract. When is it considered a rental? Well, when the primary rights of ownership, the risks and the benefits of ownership are not transferred. In this case, we might account for it as a rental. As I said, we do have criteria for this, and we'll touch upon them in a second. But in this case, if it's just in substance a rental, the lessee and the lessor are going to classify it as an operating lease. Very important to get this lingo down. The consequences of this is not any different for the lessee, but for the lessor, it is very different. And again, this is a huge departure from what we used to see when there was a huge difference for both the lessee and the lessor. So what would firms rather report, all else equal? It used to be an extreme bias for lessees to want to report an off-the-balance sheet contract and report it as an operating lease. However, since the FASB has changed the rules such that lessees have to record a right of use asset and a lease payable equal to the present value of their payments, whether or not it's in substance a purchase or a rental, this has become far less biased. Nonetheless, there's still a slight preference for the lessee to record the lease as an operating lease. This is because they avoid a little bit of, to some degree, some expenses. They keep it the expenses on a straight line basis under an operating lease versus a financing lease, which is in substance a purchase. They have front-loaded expenses that will go down over time. From the perspective of the lessor, they will almost always prefer a sales type lease and a sales type lease with profit because this allows them to record sales revenue, and we'll see that in action as we go through the different types of leases. So what are the advantages of leasing? Why do we lease at all? There's typically no large initial payment. It reduces the risk of obsolescence, which is the out-of-dateness to the lessee. So for example, you might want to rent a machine for your business for only 5 years because you know that after 5 years, you don't want to own that same machine. You'd rather be out of contract into a new machine to best benefit the operations of your business. Leases can be less costly because there's underlying collateral. So that tends to result in less restrictive covenants on the transaction, lower rates of interest, and of course, interest is always tax advantaged, which is better than just going out and purchasing the asset in its entirety. When we look at the accounting mechanics, what is the difference between them? So now we're going to get a little bit more technical. If it's in substance a purchase, then for the lessee, like I said, we have a right of use asset and a lease payable, and they're both going to be equal at the outset of the arrangement to the present value of the lease payments required by the lessee. So I might want to add that actually, required by the lessee, because there may be some payments that the lessor expects but not required by the lessee, and those are not part of our present value calculation. But for the lessee, these payments can be the rental payments for sure, but anything else that they're reasonably expected to exercise. So this is going to be a big key phrase that we have to look at. Well, what is the lessee reasonably expected to do? Are they reasonably expected to purchase the item 4 years into the lease? Well, then we include that purchase price, and the lease term is only 4 years. Are they reasonably expected to cancel the lease 4 years into it? Well, then even if the lease term is 9 years, if we reasonably expect them to cancel 4 years in, and that's an option, then we treat it as a 4-year lease. So this reasonable expectation affects our accounting to a large degree. The lessee's income statement effects. Now we're going to record amortization expense from the right of use asset. It's a cost allocation similar to depreciation, but somewhat different because we're allocating a right rather than a tangible fixed asset. And remember, the lessee is not necessarily keeping the leased asset. It's just using it. Interest expense is also going to be recognized by the lessee, and it arises from the lease payable. We'll use the effective interest rate method. Remember, the effective interest rate method from investments and bonds is the carrying value of the financial instrument, in this case, the lease payable, multiplied by the market rate. That gives me my interest expense. For the lessor, remember that for an in-substance purchase, in the case of the lessor, it's an in-substance sale. They have the removal of the leased asset from the balance sheet at historical cost, just like we would in a sale of a fixed asset. We're going to record the lease receivable as the present value of the minimum lease payments that the lessor expects, and you see that in bold below. For the lease receivable, we capitalize payments they expect to receive, even if they won't necessarily be guaranteed to receive, including a residual value of the asset. And we'll talk about what a residual value is in the second part of this module. And then the income statement effects. Well, one thing is, if we've sold the asset, we no longer record any depreciation expense. We remove the asset from our books, therefore we don't charge any more depreciation. We have interest revenue that arises from the lease receivable. The interest revenue is just like the interest expense that we found that arises from the lease payable, except of course it's a credit that arises from an asset, but it's still with the effective interest method that we've seen before, the carrying value of the lease receivable times the market rate at a point in time gives me my interest revenue. In certain types of leases, sales type with profit is the type of lease. We will record some sales profit and cost of goods sold under that sort of contract. We'll see exactly how we do that in some of these examples. So let's get to the criteria that I promised you. This is how we've been talking about in substance a purchase or in substance a rental. And these are the criteria that we base that on. Note that all we have to have is one of these to be true in order for it to be triggered as an in substance purchase. So when we're classifying the lease, we want to look at it really from the lessee's point of view. Does the lease transfer legal title to the lessee by the end of the lease term? Well, if it does, obviously this is a purchase. Does the lease contract contain a purchase option that is reasonably expected, here's that phrase, to be exercised by the lessee? Now, formally, this was referred to as a bargain purchase option, and I will do so, even though the current standard no longer uses that phraseology. If we reasonably expect them to exercise it, we act as if they are going to exercise it, which means then that the lessee will have purchased it by the end of the lease term, and therefore they own it. It is in substance a purchase. So these two actually transfer ownership, and that is something to remember. This is when we no longer, it's not even in substance a purchase, it is just a purchase that they will end up with the leased asset. Now, this has a few consequences. When the lessee is applying their amortization expense, they're going to apply amortization over the economic life because they are going to take possession of it. They're going to record this over the economic life of the asset. Now, the rest of them do not necessarily indicate that the lessee will take possession of the leased asset. Remember, because if it's just in substance of purchase, the lessee might use it for a period of time and still return it to the lessor at the end of the lease term. So, for example, the lease term may just cover a major part of the economic life of the leased asset. Formerly, this is called the 75% of useful life rule. So if the lease term was greater than or equal to 75% of the economic life of the asset, then it stands to reason that the lessee has used the leased asset for substantially all of the benefits of ownership it will give. Remember, the economic life of an asset is measured as the number of years in which it will be able to be used to generate revenue. And hence, if the lessee is generating revenue for more than 75% of its life, then we can say that the benefits of ownership have been substantially transferred over to the lessee. That doesn't mean they're going to keep it, just means they've used it for most of the life. The present value of total lease payments, including any residual that is guaranteed, represents substantially all of the fair value of the leased asset. This was formerly that the lease payments were greater than or equal to 90% of the leased assets, fair market value. Right? The idea is that if the lessee has paid for substantially the entirety of the economic value of the asset that's underlying the lease, then they are the owner for all intents and purposes. And finally, if the leased asset is of such a specialized nature that it's of no further use to the lessor at the end of the lease term, then it is not, we would imagine that the lessee has absorbed all of the benefits of ownership, even if they return it to the lessor. The lessor can't do anything with it. So the lessee was basically the owner. Now, these don't indicate a true purchase. They could be a true purchase, but they don't necessarily indicate it. So if we qualify for these reasons, we just want to apply the amortization over the lease term, rather than if it qualifies for 1 and 2, we do it over the full economic life of the asset. All right, so that is how we classify an in-substance purchase or an in-substance rental by the lessee's perspective. Now, if we're on the lessor side of things, we have one more step to take, and it's not a very difficult step, but we have to identify, we've identified with 1 through 5 whether or not it's a sales type, because the lessor can't really sell the asset if the lessee is not purchasing it. So this triggers for both of them. But then remember, there's 2 types of sales type assets, sales type leases for the lessor. There's one with profit and one without profit. And it's a really easy question. We look at the fair market value of the leased asset. That is what its price would be in an economic exchange. And if that is equal to the cost of the leased asset, then we have no profit, right? If you think about sales revenue, cost of goods sold, if those two are equal to each other, then we have no gross profit. But if the fair market value is greater than the cost of the asset, then we have some gross profit. So that's all we need to figure out. It's really, really that simple. So overall, I kind of want to mention that I believe the FASB is moving toward a principles-based approach in lease classification. Prior to this, the old standard made direct reference to thresholds. 90% of the lessee's payments is greater than or equal to 90% of the leased asset's fair market value than it is in substance of purchase. Notice now we don't have that 90%. It's footnoted. It's down in the standard. But what we have instead is that these payments represent substantially all. So it introduces some ability for auditors to challenge, even if it doesn't necessarily equal or amount to a value greater than 90%. Same thing with the 75% rule. A major part of the economic life, not greater than or equal to 75%, which was the old standards verbiage. So we're moving away a bit from these bright line thresholds and just trying to introduce a little bit of judgment into the process. We're not abandoning it completely because these are still in the standard. They just aren't as prominently placed in the standard and have introduced some room for challenge. We'll see if the auditing profession takes it up on, takes that up and actually exercises it. Because now the professional judgment really doesn't mean as much as it used to. It used to mean a lot, a great deal, because remember, there was off the balance sheet financing possibilities for the lessee, whereas now they have to record the right of use asset and the lease payable no matter what happens. All right, so let's look at a contract here. We have a contract between Widgeon and they're leasing from Mallard. So always identify, of course, the lessee, and in this case, Widgeon, oops, 2 S's, 2 E's, is the lessee, Mallard is the lessor. Under the terms of the non-cancelable agreement, Widgeon is required to pay $20,795. Remember, we're going to be calculating present value, so you want to identify those items as well. They're at the beginning of each of the next 8 years. That's something interesting about leases, is a lot of them are not ordinary annuities like we're used to with debt, but they're annuities due, where the first payment comes at the beginning of the year. The lease term, each of the next 8 years beginning immediately. These 8 years represent the lease term, and that's our N in a present value sense. The estimated economic life of the leased asset is 10 years. This is good to know. This is going to help us with that classification, because remember, criteria number 3, got to get those criteria down, tells us that if we've leased it for a major part of the economic life, that it's in substance of purchase. The interest rate implicit in the lease contract is 10%. This is going to give me my I. We'll talk about the different types of I's there are. There's 2 types, but we want to use the implicit rate, which is the one set by the lessor. Mallard originally purchased the fixed asset for $122, so that's its cost to Mallard. And I tell you that that's equal to its fair value. So in this case, we have cost equal to the fair value, which implies that if it is in substance of purchase, it is without profit. The lease does not transfer ownership, and this type of asset is routinely leased and released by Mallard. So it doesn't qualify by criteria number 1, because if it did, we would transfer ownership. So criteria number 1 is not met. And this last sentence, if it's routinely leased and released, then it's not of such a specialized nature. So criteria 5 is out as well, right? So you really want to pay attention to those criteria, because typically the first question I'm going to ask you is, how do you classify this lease? How do you know how to classify it? Well, 1 isn't true. 5 isn't true. How about number 2? Do you remember number 2? Number 2 is about the bargain purchase option. And it would have to be specified in the lease contract that, for example, at the end of 5 years, the fair value of the leased assets is expected to be $30,000. The lessee has the opportunity to buy it for $5,000. Well, yeah, who wouldn't exercise that sort of a option? Because you spend $5,000, you get an asset worth $30,000, right? Well, there's no bargain purchase option here, so it doesn't qualify for number 2, no BPO. So it's not number 2. Number 3, recall, is the major part of the economic life. Well, we have a lease term of 8 years and a full economic life of 10. That yields us 80% of the economic life. Yeah, I'd say that's a major part, right? Definitely greater than 75%. So let's just keep going so I can show you how to do the others as well. Number 4 says, are the required lease payments, the present value of the required lease payments, greater than or equal to 90% of the fair market value? Well, again, now we have to start calculating the present value. You're going to have to do it anyway, so might as well do it, even if you've satisfied the in-substance purchase through another criteria. Now, in this case, there's no future value that the lessee owes. That only happens if there's a single lump sum payment that the lessee is going to pay at one point in the future. They do owe a series of annuity, right, for 8 years. They owe $20,795 every year for 8 years at the beginning of the year. So it's an annuity due. And then we have a 10% rate. So if you plug those into your calculator, you'll get a present value of $122,034. And to examine the truth of criteria 4, we would take those payments, 122,034, and put it over the fair value to see if it's substantially all of it. Well, yeah, it is actually, in fact, all of it. So it would qualify for either 3 or 4, right? So we don't have an actual purchase, but we have what is in substance a purchase. So how do we write the journal entries? Well, we had the lessee, who is Widgeon, and then the lessor, who is Mallard. You need to know the accounting for both. And of course, they tend to be pretty symmetric, especially on a basic lease transaction. Well, the lessee, Widgeon, is going to record a right of use asset. And I'm just going to shorthand it ROU, asset. They're going to record that for the present value of the lease payments, 122,034. Now, you can do the accounting for this one of two ways. I'll do it one way for the lessee, the other way for the lessor. Some people, it just depends on whether they want to record a whole lot of stuff at once or if they want to do more detailed entries. So we could, for example, set up the ROU asset for 122,034 and then the lease payable for the same amount. Remember then also on January 1st, they pay some cash of $20,795. They make that first cash payment right away. And that reduces the lease payable on that day. So the lease payable gets reduced by $20,795. Well, what's the other way of recording it? I'll record the lessor in the alternate way. Well, basically, we're just combining these two entries. The lessor, instead of recording a right of use asset, they record, because we have in substance a purchase / sale, it's a sales type lease to the lessor, they remove the leased asset from their books. They take it off at its cost. Its cost is $122,034. What are they going to record in instead? They're going to record a lease receivable for the same amount, but they also receive cash this day. So this is what I mean by just combining those. And then you would record the lease receivable rather than debiting it for $122,034 and then turning around and crediting it for $20,795. You can just record the net of those two transactions, yielding $101,239. I don't care which method you use. This method might be a little better when it gets really complicated. When it's really basic, this might be easier to do. Your call. I don't care. Record any necessary accruals for 2019 that would be recorded for 12/31/19. So remember, the payments don't come to the beginning of every year. Well, the beginning of this next year is we still need a report. If we have a fiscal December 31st fiscal year end, we have to accrue any interest. And both of them have interest going on. So remember, the carrying value of this asset is affected immediately. We record, or for this liability, in the case of the lessee, we recorded it at $122,034, but then we made an initial payment to reduce its value immediately, which yielded $101,239 net. That's the carrying value at January 1st of 2019. So that's the only amount that accrues any interest. Right? If we hadn't made that initial payment, then we would have done it on the full amount because that's the amount that would have accrued interest. But because it's an annuity due, we don't have the full amount. Then we record interest expense and interest payable. And we do that for 101,239 times the market rate, which yields 10,124. Well, because in this example, the lease payable and the lease receivable are at identical carrying values of 101,239, we record the same amount for the lessor, except we record interest receivable and interest revenue, right? They get to record the revenue because they've earned it. They've allowed the lessee to use this asset, and time has passed with the financial instrument that represents the payments of the lessee. So they get to record the revenue in that year. Now, the lessee has an additional entry to make. They have to make an entry for the amortization expense. And remember, the amortization expense is resulting from the right of use asset. We recorded that at 122.34. And because we declared this in substance of purchase due to meeting criteria 3 and 4, we want to only do it for the lease term for 8 years. And so this results in 15,254. And because it's amortization, we do not have an accumulated amortization account. We write down the value of the ROU asset directly. So that's what it would look like at year end. All right, let's look at the first payment that's made at the beginning of the next year, January 1st, 2020. So in this case, we have the cash being paid by the lessee. They're going to pay cash of $20,795 as required in the lease contract. The first thing it's going to do, remember, we just recorded a payable of $10,124. They have to pay off that interest first before they make a dent in the lease payable. So they're going to pay off the interest payable, just like you do when you're paying your mortgage, pay some interest, then the rest goes to the principal. $10,124. And then the lease payable is going to be reduced by any amount that's remaining. It's your plug. So that's $10,671. So this is a lot like amortization, except rather than amortizing a premium or discount, we're slowly reducing the lease payable or the lease receivable itself. The lessor records something much the same, except opposite, because it has cash coming in of $20,795. It reduces the interest receivable because this cash is paying off some of that interest, the interest of $10,124. Notice it's the opposite of the interest payable. And then the rest of it goes to reduce the lease receivable. So again, remember, the lease receivable is the opposite of the lease payable. And we're going to reduce that by $10,671. Yeah, that's horrible. I can't even leave that there. It's so disgusting looking. I don't know how some of you live with your handwriting. Mine's bad enough. And then I look at yours and I think, thank God. Anyway, so this is the second lease payment. All right, now let's look at the amortization. According from the lessee's perspective, we have a lease payable and a right of use asset. So there's really two tables that I've combined in one. Now, one thing about these tables is that I have the dates established at January 1st. This is going to refer to what is the carrying value of these items at each date, right? Now, it's important to remember that the interest expense actually accrues in the year prior. So for example, we have the inception of the lease, right? We make an initial payment. There's no interest expense because we make that initial payment right away. Nothing's accrued. So the whole thing reduces the liability of the lessee and reduces it from 122,033 down 20,795 to 101,239. Well, that's just this journal entry we made here, right? We recorded it at 122,034. We reduced it by the full amount of the payment, 20,795. Now, notice in the second column, I have the interest expense that accrues from this carrying value. 101,239 times 10% gives me 10,124. Now, it's in the 112,2020 column, but this actually accrued in 2019. It got paid off 1/1/2020 by our payment here, right? It accrued in the prior year. That's why it's payable on January 1st, 2020, because we had a fiscal December 31st year end. We pay off that payable. We have 10,671 left to reduce the lease payable. It goes from 101,239 minus 10,671 to a value of 90,647. So really, you know, and if you want to think about it in T accounts, which I'm always a fan of T accounts, as you well know, lease payable, right? It was at 101,239. We just debited it by 10,671. Well, then 90,647 is left after the payment on 1/1/2020, right? Then during 2020, 90,647 times 10% arises in interest expense, but it's not paid down until 1/1/21. So I think you get that. Talk it through with yourself a few more times, because that's really important to understand that. Now over here, we have the right of use asset. It has its carrying value. Remember, we're just amortizing it straight line over 8 years. So it's 15,254 every year, dropping it down all the way until it's going to hit 0. Right? Well, let's look at example number 2. Now, I'm changing just a little bit, right? The thing I'm changing is I'm now telling you, instead of Mallard purchasing it for 122.34, they manufactured it. Right? When you purchase it, you're going to pay a higher price. When you manufacture it, you kind of get that economy of scale, right? You built it, so you probably have a margin then. Well, in this case, the cost to produce the leased asset was only $65,000. So now we have a $65,000 cost and a $122,034 fair value still. Because the only thing I said that changed here is that we manufacture it. The fair market value of the asset is still $122.34. So what does this change? Well, now we have a fair value in excess of cost, right? We have a fair market value that's greater than cost. Well, this implies that we have a sales type with profit. Nothing else changed. So it was still an in-substance sale / purchase. So it is a sales type to the lessor, only now it's a sales type with profit. So let's look at how that changes up our journal entry. Under this scheme, now Mallard is going to record sales revenue. So the lessor changes, but the lessee does not alter their accounting. It's still an in-substance purchase for the lessee, but they don't even know if the lessor is making profit or not. They might, but it doesn't change anything, okay? But they wouldn't have to know. So it doesn't change anything for them. Now, the only thing that's really going to change for us on the lessor side, well, first, that leased asset is no longer at a cost of $122,034 to Mallard. It's only at a cost of $65,000. They still record a lease receivable for everything they are going to receive from the lessee, the present value of their payments, less the initial cash payment. The initial cash payment hasn't changed. The lease receivable, right, would have been $122,034 because that's what the lessee has promised them. Remember, that's the present value of the lessee, their payments. So they're still going to get all of that. They're just taking off the first payment to get that initial amount, which we found to be $101,239. Now, we have an imbalance, obviously. Well, the rest of it gets filled in by sales revenue. And the lessor is going to record sales revenue for everything that the lessee is obligated. In this case, the lessee is obligated to all of that, right? The 122,034. We'll see sometimes the lessee is not obligated to everything that the lessor capitalizes into these amounts. It's an interesting deal. We'll see it later on. Right now, we're keeping it simple. Well, if we record sales revenue, we got to match it with cost of goods sold. First, the same amount of the cost of what we're selling, right? So now it's like inventory. So that's how that changes. They still earn interest revenue. The lessee is still recording interest expense, right? Everything else continues on from the last example. So let's look at Widgeon and Mallard one more time and change things around again. I lie. It's not just the final time. Billy is a liar because you're going to see him at least 3 more times. All right. But it'll get more and more interesting, I promise. Interesting meaning not fun. The new useful economic life of the leased asset is 16 years. You probably already see where I'm going here. Well, wait a minute. If it's 16 years and we don't change the lease contract, 8 divided by 16 is only 50% of the useful life. Well, that means that it's probably not going to be an in-substance purchase under criteria number 3. The fair value of the leased asset at the date of the lease contract is 160. That's our fair market value. So again, this is looking different. The cost is still 65. All right. So it looks like we might have a with profit sales type if it is in substance a purchase. Mallard still routinely leases and releases this type of asset. So criteria 5 is out. We're not going to have an in-substance purchase because of criteria 5. There's no bargain purchase option. Just no option. So there's not a bargain. And there's no transfers of titles. So now criteria 1 and number 2 are both out. All right. So, it looks like it might be in substance or rental. The lease contract is still set for 8 years. And so, yes, indeed, criteria number 3 is no-go. The payments of $20,795 begin immediately and are due each January 1st. So that's still the same. Still PMT of $20.95. Still an N of 8. It's still an I of 10. So if we take the present value for the lessee, we have a payment of $20,795. We have an I of 10%. We have an N of 8. And there is no single lump sum payment, so our future value is 0. So it's the same present value as we've seen before in the last iteration of this problem, 122,034. The difference is now if we check criteria 4, this is the present value of the lessee's payments. Well, is that substantially all of the fair market value, 160? Well, if we take the ratio of those two numbers, you'll find it's approximately 72%, which I would not call substantially all. So criteria number 4 is out. So we have invalidated all the criteria. 1 and 2 are out. 3 is out. 50% is not a major part. Criteria 5 is out. Criteria 4 is out. It's an operating lease. Of course, that's the last type that we hadn't seen yet. So, interestingly, again, huge change is that we no longer, for Widgeon, are going to record a nothing. We have to record for Widgeon, the lessee. We have to record a right of use asset and a lease payable. So our right of use asset is still the present value of these payments. We still have a lease payable that would also be equal to that, but we pay cash right away at the beginning of the year. We make that cash payment for $20,795. Hence, we only record $101,239 of the lease payable. We've seen it before, but again, this is a huge departure from the old standard where we would have recorded almost nothing. I'll show you basically, the flip of what we would have recorded for Widgeon. Mallard is the lessor because it's no longer in substance a purchase sale. Mallard has an operating lease. Well, they don't record a lease receivable anymore. They don't remove the asset. They just receive the cash paid by Widgeon. And they haven't even provided the leased asset. So they have deferred lease revenue, if you will, of $20,795. So they actually have to provide that asset for a year before they can recognize that revenue. Well, under the old rules, Widgeon would have just recorded a credit to cash and a debit to prepaid rent. But now we have a whole lot more going on. Provide the year-end adjustments. This is where it gets really kind of wonky. Okay, let's do the easy first, right? Lessor. Well, they've earned that deferred revenue. They've provided the leased asset for a year. So they get to record the lease revenue associated with that provision. They also, because they haven't sold the asset, have to now divide it over the useful economic life. Well, the useful economic life was 16 years, and the asset to them had a cost of $65,000. I changed that from my first iteration of notes, just so you know. Just because for consistency, but whatever. That is equal to 4,062.5. So they would record it as depreciation expense because they're not allocating a right of use asset. They're actually depreciating a fixed asset. Now, the weirdo is Mallard. And it's like I said in class, it's a little asinine how we're doing this now. But what you want to think of is that we want to report a straight line expense, one line item. It's going to be a one line item on the income statement. It's called lease expense for the lessee. We want to match it equitably in a straight line fashion over the lease term. How did I come up with this $15,254? Well, because they're going to have it for 8 years according to the lease term. The contract says the lease term is 8 years. And we just recorded their right of use asset for $122,034. Well, $122,034 divided by 8 gives me the straight line amount that I want to amortize or to represent the total lease expense. Because now we're going to break it into two pieces, interest expense and an amortization. Well, the interest expense is still defined by the effective rate, the effective interest rate method. So it's the carrying value. Remember, in this case, the carrying value after that first payment is 101,239 times the market rate of 10%. That's 10,124. So that's the interest expense I would want to record. All right. Well, that fills out the interest expense that I would have. Well, what should I record for the amortization then? I can't just record the amortization of the full ROU over 8 years because that gives me the straight line, which is what I'm trying to achieve. Well, then that means the amortization has to be the plug, whatever makes this balance every year. So for the first year, it would be the difference between my straight line lease expense minus 10,124 gives me an amortization plug of 5,130. For the second year, so notice what's going to happen is that my interest expense dwindles over time because the carrying value of my lease payable reduces over time. And because we have a straight line expense, we're always trying to achieve, my amortization will increase over time as my interest expense falls. So this is just the first 4 years, obviously, but this trend would continue, and it would continue with the same process year after year. Right? So then for the lessee, for the end of the year, we would record interest expense and interest payable as before, 10,124 each, and then we would record the amortization for the amount we found as the plug in the first year of 5,130, the ROU asset, the same amount. Right. A little wonky, a little arbitrary, a little convenient. I'm not sure what else you might want to call it, but hey, now we have an ROU asset on the books and a lease payable to show that there is no way you can get off the balance sheet financing anymore. End of story, right? Well, end of the FASB's standard, more or less. The thrust of it, the difference between what was and what is. So let's look at the discount rate. There is two possible rates that we could use. The first we've been using so far is the implicit rate of return. That's what the lessor builds into their contract. That's their rate of return on the contract. Okay, so that's typically what we want to use if it's available. The other one, if the lessor's rate is not available, or if we alter the lease contract in some way, we will want to use the market rate at that time or the lessee's incremental borrowing rate. That's basically what we call the market rate in other transactions. It's the rate that the lessee would have to pay if, for example, rather than enter into a lease, they went to the bank instead and said, hey, I want to lease an asset. And then the bank would tell them, oh, okay, well, then we're going to give you an 8% note. Well, then the lessee's incremental borrowing rate is 8%, whatever they could get on another one, on a different sort of loan. Right? So the overview so far, 2 ways to classify a lease for the lessee, operating or financing, 3 ways for the lessor, sales type with profit, sales type without profit, or operating. When we have a sales type for the lessor, it is an in-substance purchase / sale. So that lets us remove the leased asset, not the lease, the leased asset, not the lease itself. That's a typo. The lessors record sales revenue and COGS when there is a sales type with profit. And remember, that only happens when we have a fair market value of the leased asset that's greater than its cost. The lessors record depreciation in operating leases, but not sales type, right? Because in a sales type, they get it off their books. In an operating lease, it's still on their books. Lessees have front-loaded expenses in financing contracts. So that's when we have an in-substance purchase. Interest expense is greatest at the outset. Amortization tends to be flatlined. So over time, their total expenses are going to go down. They have straight line expenses in operating leases and operating lease contracts, and that again is due to convention. We just straight line it over the lease term. And then classification doesn't matter. It doesn't alter some accounting conventions in lease contracts. Lessees are always going to record a right of use asset in a lease payable. Lessees are always going to record some interest expense because they're always going to record a lease payable, right? All right. One case, and I just told you that they're always going to do it. One case they don't is a short-term lease. The only instance that there's no ROU or lease payable recorded by the lessee. Well, this is only if the lease term is less than 12 months and there are no extensions or renewals that will be expected to be exercised, right? So they can't set up a convenient little contract where the lessee can continuously renew after a year, because then that would just be short-term lease, short-term lease, short-term lease. Well, if they can continue to do that year after year, then we'll see soon that's an uncertainty that we know if they're incentivized to do, they would do. So it becomes a long-term lease, right? So it can't have a bargain purchase option. It can't have a bunch of renewals and extensions that take it beyond a year. If it's this way, plain Jane, simple accounting for both, they just record a lease expense and record a credit to cash. That's the lessee. The lessor receives the cash and records lease revenue. End of story. We'll get into that whole uncertainty part in just the next module and get more detail thrown on top of it. Thank you very much for watching.